Hey everyone, welcome back to the channel. I'm so glad you're here today because we're diving into one of the most important parts of buying a home and one of the most misunderstood, how to actually finance it. So if you've been thinking about buying a house but you're unsure which loan is right for you, what credit score you need, or how lenders really decide whether to approve you, this video is going to walk you through everything from start to finish. I promise you, by the time we wrap this up, you're going to feel like you could walk into a lender's office tomorrow and have a confident, informed conversation about your options. So before we start comparing different types of loans, let's take a minute to talk about credit scores, because this is one of the first things lenders look at when you apply for a mortgage. Your credit score is basically a 3-digit summary of how you've handled credit in the past. Lenders see it as a quick way to measure your risk level. The higher the score, the less risky you appear to them. A perfect score isn't required to buy a house, but it can save you thousands of dollars over the life of your loan. So while every lender has their own guidelines, there are certain score ranges where the doors start to open to better rates and more flexible terms. Think of it as a spectrum. The higher you are, the more negotiating power you have. But that doesn't mean you can't buy with a lower score. Now let's start with the loan that most people are familiar with, the conventional loan. This is the most common type of mortgage offered by banks, credit unions, and mortgage companies. It isn't backed by a government agency like the FHA or VA, but instead it follows guidelines set by Fannie Mae and Freddie Mac. Most lenders want to see at least a 620 credit score to qualify for a conventional mortgage. But if you're aiming for the best possible interest rates, you'll want to be up to the mid to upper 700s. Down payments for conventional loans can start as low as 3% for certain buyers. But if your score is on the lower end of the debt-to-income ratio is higher, you might be asked for 5 to 10 or even 20% down. Another thing to keep in mind with conventional loans is that if you put less than 20% down, you'll likely have to pay a private mortgage insurance, or PMI. PMI is an extra monthly cost that protects the lender, not you. But the good news is that with a conventional loan, you can request to have it removed once you reach 20% equity in your home. Then there are FHA loans, which are designed to be more accessible, especially for first-time home buyers or even those with less than perfect credit. FHA loans are insured by the Federal Housing Administration, which means that lenders can be more flexible in who they approve. You technically get pre-approved for an FHA loan with a score as low as 500. But if your score is between 500 and 579, you'll need to put down at least 10%. If your score is 580 or higher, you can get in with just 3.5% down. FHA loans do come with their own version of mortgage insurance, called the Mortgage Insurance Premium, or MIP. There's an upfront cost, which you can usually roll into your loan, and there's an annual premium you pay each month. One key difference from conventional loans is that unless you put down the 10% or more, the FHA mortgage insurance stays in place for the life of the loan. That's something to consider when comparing costs over time, because while FHA loans are more forgiving on credit and down payments, they can end up costing more in monthly fees unless you refinance into a conventional loan later. So if you've served in the military, the VA loan is one of the most powerful home financing tools available. So backed by the Department of Veterans Affairs, VA loans allow qualified service members, veterans, and certified surviving spouses to buy a home with no down payment and no monthly mortgage insurance. The VA itself doesn't set a minimum credit score, but most lenders prefer to see at least a 620, which makes VA loans so appealing is not only the zero down feature, but also the competitive interest rates and lower overall closing costs. So over the years, I've seen VA loans make homeownership possible for people who might otherwise have had to wait years to save for a down payment. And the absence of PMI means that their monthly payment is significantly lower compared to other loan types. There's also the USDA loan program, which is another zero down option, but it's intended for rural and certain suburban areas. You might be surprised at how many communities qualify for USDA loans, even in Northern Kentucky. USDA loans have income limits, so you can't make over a certain amount for your household size. But if you qualify, they can be an excellent way to get into a home without having to save up for a big down payment. So most lenders prefer a score of 640 or higher for USDA, but manual underwriting is possible for lower scores if you have other strong factors like steady income and low existing debt. USDA loans do have a small monthly guarantee fee, similar to a mortgage insurance, but the cost is usually much lower than what you would see with an FHA or conventional PMI. So when you're looking at homes that are priced above the conforming loan limit, which is most of the country for 2025 is around $766,550, you'll enter the world of jumbo loans. Jumbo loans aren't backed by Fannie Mae or Freddie Mac, so lenders get stricter requirements to offset the higher risk. So in most cases, you'll need a credit score of at least 700, a down payment of 10 to 20%, and a strong financial profile with reserves in the bank. Because you're borrowing more money, the lender wants to see that you have both the income and the financial discipline to handle a larger payment. Sometimes jumbo loans interest rates can be slightly higher than conventional rates, but depending on the market and the lender, they can also be very competitive. Another category worth mentioning is the adjustable rate mortgage, or ARMs. These loans start with a fixed interest rate for a set period, often 5 to 7 or 10 years, and then the rate adjusts annually based on the market conditions. The appeal of the ARM is that the initial interest rate is usually lower than what you get with a fixed rate mortgage, which can make your payments more affordable at the start. The potential downside is that once a fixed period ends, your rate and payment could increase. ARMs generally require similar credit scores to conventional loans, so if you're looking at a 620 or higher, but lenders will pay close attention to your overall stability because of the potential for future rate changes. Beyond these main loan types, there are also specialty products that can cater to very specific buyer needs. For example, physician loans are designed for doctors who are just out of medical school or residency. These buyers often have high income potential but may not have had time to save for a large down payment, and they might still be carrying significant student loan debt. Physician loans often allow for little or no down payment and don't require PMI, even with less than 20% down. There are also renovation loans like the FHA 203K or Fannie Mae home-style loans, which will let you roll the cost of repairs or improvements into your mortgage so you can buy a fixer-upper and make it a move-in ready without needing separate financing. Of course, no matter which loan type you're considering, your interest rate is going to play a huge role in how affordable your monthly payment will be. Rates are influenced by a combination of your credit score, your down payment amount, the type of loan you choose, and broader market conditions. Even a small change at rates, say 0.5%, can mean the difference of hundreds of dollars a month in your payment, and tens of thousands of dollars over the life of your loan. That's why improving your credit score before you apply can be one of the smartest moves you make. Paying down revolving debt, making all your payments on time, and avoiding new credit inquiries in months before applying can help bump up your score enough to get you into a better price tier with your lender. Lenders will also look closely at your debt-to-income ratio, which compares your total monthly debt payments to your gross monthly income. Even if your credit score is excellent, a high debt-to-income ratio can limit your loan options or the amount you qualify for. In most cases, lenders want to see your total debts, including your future mortgage payment, stay below 43% of your income, though some programs allow higher ratios with compensating factors. When it comes to time to apply, you'll need to provide documentation that shows your income, assets, debts, and credit history. This typically includes recent pay stubs, W-2 or tax returns, bank statements, and identification. Being organized and having these ready can speed up the approval process and give your lender confidence that you're a serious, prepared buyer. As you can see, there are no single best loan type. It all depends on your credit, your savings, your income, and your future plans. For some, a conventional loan with a low down payment and cancelable PMI is the right fit. For others, FHA flexibility makes homeownership possible sooner. VA and USDA loans offer incredible zero down opportunities for those who qualify, while jumbo loans and specialty products open doors in higher price markets are unique situations. The key is to start early. Talk to a trusted lender and explore all your options before you fall in love with a house. If this is the first time on the channel and you want to know everything there is about living in Northern Kentucky and the surrounding areas, then subscribe below, tap the bell for notifications so you can be the first to learn about the current market in Northern Kentucky. My name is Carrie Empero. I get calls and emails every single day from people like you, and you, looking to make their move to to Northern Kentucky. So whether we're moving in 9 or 90 days, just give me a call, shoot me a text, or send me an email. Happy to help you make a smooth move to Northern Kentucky.